Hi folks, Scott here, and this is the wrap for Monday, July 22nd. So a pretty quiet day today, very quiet actually. Another doji or near doji candlestick, which will probably show up in our worksheet. I say probably because I haven't measured. This is getting very close. There's a specific measurement I use for our worksheet, but that'll show up more than likely, and we'll show you the results of fading gaps after candlesticks tomorrow. Same with the fact today's could have been an NR7 day. I'm just eyeballing this, the most narrow range day of the past 7. Actually, maybe not. That looks a little bit more narrow. Tomorrow's Tuesday. It's the 23rd. We had another higher high and a higher close, both futures and cash indices. So market continues to grind and march upward towards 1700 area. Could be a psychological area. That's one thing that stands out. But going into tomorrow, one of our members suggested a test showing you the results of fading gaps when the market has stretched and been at least 0.9% higher, but no more than 1.2% higher. So just the difference between the close and the 10-day moving average, being fairly well stretched, but not as much as it has in other times. So it's sort of this stretch range, if you will, of 0.9% to 1.2%, and also being above the 200-day moving average. And there you go. It's happened about 150 times, so a fairly common area to be relative to the 10-day moving average, even though we are very stretched. As long as it keeps sloping as hard as it is, we're staying within reach of it, if you will. Using an end-of-the-day stop, it shows historically there's been a 75% win rate for gaps to the downside, and they've been, 25% more probable than up gaps in such a situation. So odds favor a gap down, and using an end-of-the-day stop, it's actually had a slightly better win rate. So slightly above average numbers here for fading down gaps. Fading up gaps, average to slightly above average, one could argue. So not a bad environment to be fading gaps, at least based upon this particular study. Let's see how it's done this year. Ooh. The exception has been this year has been terrible. 2009 was also terrible. That's interesting to note because often moves, big macro trends and micro trends as well, start off big, right? They make significant moves early on in the trade or in the period of the move, and at the end it tends to get exponential. So maybe that's what's going on here. Maybe that's why the market starts off racing and then grinds higher, and then it starts just killing the shorts in this case, and that's why it hasn't done well this year. So out of 11 trades, only 45% were profitable. So what's that? 5 has lost a bunch of money. So that's not enough to keep me from trading at all, because this is just one study, and that's a terribly small sample size. Overall, I always defer to the bigger numbers. These are decent numbers here, and then we'll defer to our gap guides and my other worksheet, other unique patterns and event and daily unique day data in the worksheet as well. All right, let's take a look at what we showed going into today. This could be a short wrap because the markets are just so quiet. Ended up with you had potential of some possibly interesting setups, but really this area here was almost non-existent in most markets between the high and the close. So we're looking at gapping above the highs was a high probability scenario, or more likely based upon the odds of shown here for opening odds, between the close and the low, and that was more neutral. OPEX Monday, pretty mixed, slightly positive for shorting up gaps. I'm not going to show you the gap guides because the gaps were so small and nominal in different directions. There's really not a whole lot of value there, but some of this data was interesting. OPEX Monday after 20-day high close specifically, it's actually shown good probability in both directions on small sample sizes, decent win rates. After fade gaps after a 50-day high close on a Monday when above the 200-day moving average has shown pretty good numbers for up and down gap, but extended targets clearly favored if shorting up gaps. So it tells you to possibly watch out for some resistance above. But depending upon the markets, I think the ETFs, most of them opened down and most of the futures opened up because of the closing variance on Friday, which is what I commented on here. And just bottom line, the whole setups are just too weak for me to trade on a Monday. So I left them alone. Let me show you the action, which won't take long. That's the S&P. That's the Russell. NASDAQ, and the YM. So two-sided action in the YM, two-sided action in the ES. And what I mean by that is a price trade on both sides of the blue line, which is the close as of Friday. Two-sided action in the Russell, though mostly positive, and two-sided action in the NASDAQ, the mostly positive. One of the things I did point out that's an interesting note is what happens if the NASDAQ catches a bid, because this has been pulling back. So tell people to pay attention to this action here. If it goes up and fills this gap, markets could continue another leg higher, at least run some more stops and maybe finish with a bang. Who knows? Let's see. The range guides did not show any clear edge in either direction, and that's a good thing, 'cause I'm not sure many of them would have worked today. Markets just didn't do much. So I read it properly this morning, left everything alone, and got some other good work done here at Match the Gap, and we'll see what tomorrow brings us. But that was the very quiet and dull Monday for me, and my trading plan. So have a good one. We'll see you tomorrow.